This week it's worth taking some time to assess the updated forecast we have from the RBA's latest statement of monetary policy, which was released last Friday, and also to think about the implications for consumer sentiment that have come from both the budget as well as the rate cut that we saw from the RBA last week. So in terms of the statement of monetary policy, there was a number of, interesting changes being made, particularly around inflation. But we'll start with regards to growth. They continue to believe that we'll see growth around about trend or a little bit above this year, next year, and then sort of accelerating above trend in 2018 to the midpoint of that year. That's unchanged, although it is fair to say that this time around they have a lower interest rate forecast assumption in that profile. So at the time when they prepared the statement of monetary policy, they were looking for not only the rate cut that had been provided the previous Tuesday, but also a further rate cut by February next year. So that suggested if they didn't actually change that profile, then we would have seen a lower growth outcome in that statement of monetary policy. The main focus for us was around the inflation forecast, given that was really the basis for the cut the previous week. And what we saw there was quite a significant adjustment in terms of their expectations around inflation. So this year they're looking for sort of a midpoint of around 1.5%, and then in 2017 and to June 2018 they're looking for the midpoint to be around about 2%, which is actually the lower end of the RBA's target band. So what that really emphasises in this year, they're expecting to basically miss their target by about 0.5 percentage points, and then looking to basically be at the bottom end of that target range for the next 2 years. All that really emphasises the need to provide further accommodation, which we expect to see in August, sort of coming through in terms of a 25 basis point cut to 1.5%. In terms of, what's leading them to have the weaker expectation around inflation, it's really about the breadth of weakness we've seen in the non-tradable sector, so health, education, and also a softer housing component, which has been a key sort of factor in Q4 and now in Q1 as well. But there is also, an element to this which is, uncertain. They continue to believe that we're likely to see the inflationary pass-through from the Australian dollar come through, albeit with a lag, and they put about a number of about 0.5 percentage points on that over the coming years. So what that actually suggests is that even though we have got this kind of midpoint forecast that low of the band at 2%, there's potentially downside risk there if we continue to see the same competitive forces that we have been seeing in recent quarters offset that inflationary impact from the Australian dollar. So it's going to be a point to watch, and that would be if that did come through and if we saw a further weakness in the economy, then that's potentially emphasising that they may retain an easing bias after that August rate cut and potentially need to lower forecasts and also the cash rate further come 2017. But obviously that will take time to assess. In terms of sort of the impact that we've seen in terms of consumer sentiment from the RBA cut, it was unquestionably strong. We saw an 8.5% increase in consumer sentiment, which took us back above the optimist equaling pessimist threshold of 100 to about 103. Now that's within the band we have seen over the last couple of years. We've been oscillating around that 100 mark, but it's still a significant improvement. And we see really evidence of the rate cut being behind that improvement coming through in terms of the respondents who have a mortgage responding with a 15% increase in their sentiment in the month, which is obviously a very, very strong outcome. If we contrast that to the questions we asked around the budget, what we see there is the budget was regarded as being a negative for family finances and their current situation, albeit not really any particularly different to what we saw last year, and actually considerably better than what was back in 2014, which was quite a negative shock for the household sector. So it's really painting, a picture where we see that there is a degree of uncertainty around the outlook and what the budget might mean in terms of the implications around superannuation and reducing the tax benefit that is being provided there. And people are sort of being a bit concerned about that. But at the same time, obviously, we've had this cash rate offset, or more than an offset, which has led to quite strong confidence. In terms of the detail from the survey as well, we saw the outlook components, so family finances for the year ahead, as well as the 1 and 5 year outlook for economic expectations, all were quite robust, and they saw quite significant increases. The sort of relative to a year ago for the family finances only improved marginally, and that potentially is, a point of contention, and might mean that we don't see as much pass-through of that sentiment into actual spending. We'll have to sort of assess conditions as we go forward. With regards to the housing market, we continue to see a lot of volatility in those indicators. Time to buy definitely improved, and it was most notable in New South Wales, but it still remains lower than it was a year ago. House price expectations actually came off a little bit, which is potentially a question around affordability and the potential for further significant gains going forward. And they're about 16 percentage points lower than they were last year. So that, again, emphasises we're likely to see modest price growth going forward, and there is potentially potentially, I guess, a little bit of downside risk there in terms of seeing sort of more stagnant prices as we move forward, irrespective of what the RBA has done. So it'll be a little bit of time to assess sort of what implications the rate cuts do have for house price expectations going forward, whether they persist, as well as kind of whether we do see that momentum come through in house prices. Next week, there's a number of key points. We do have the minutes from the RBA as well as the FOMC, so it's going to be quite important to, I guess, get a broader understanding as to where the discussions have been had and what are the key risks around the outlook for both authorities. Obviously, we're looking for that cut for the RBA in August and a hike from the FOMC in September, so it'll be really important to see how they're assessing global conditions and also the domestic picture. In addition to that, for Australia, we have the labour force release, which will always be is a key release to assess momentum and potential for income growth in the household sector. And for the US, we do have an inflation print as well, which, given sort of the volatility and uncertainty we have seen in inflation around the world and the importance of that to the FOMC's sort of position on policy, that's going to be another key release. So we'll see you next week.